Did somebody wake the bear? Find out on the IssuesWatch podcast. Hello and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. So, why did I say did somebody wake the bear? Because over the past few episodes I've been saying that the FASB really hasn't been doing anything lately or hasn't come out with anything lately, and now they just came out with 2 pronouncements. So if you hear some banging going on, it's not the FASB trying to come out with more pronouncements, it's just some construction that's going on, so I apologize for that. So why did I say that they came out with 2 pronouncements? They came out with ASU 2023-04 and 2023-05. Now I'm going to go through those 2. And you're going to hear they're kind of point specific, so don't zone out, because some of it will kind of relate to you or ultimately may bleed into relating to you. And it's not just about those that are in public practice, that are dealing with clients. We also have a lot of viewers that are in industry and a lot of them that work for SEC companies. So you're going to find that one of these relates specifically to you. So 2023, or first before I get to that, I just yesterday or the other day, I sat through a private company council meeting. I listened in on it. Now, if you don't get information from the FASB, I recommend that you sign up for their email alerts. They're really, really good. You kind of see, they send it out, they talk about their meetings that are coming out, they talk about the meetings that they had, and they go over some of the information that you need to know or you need to be thinking about. So it's an email. I know we all get a lot of emails, but it is really good. And one of them recently, they said that they're having a PCC meeting in addition to a regular FASB meeting. And I decided to listen in on the meeting. It's really good because you hear the dialogue between the attendees. And on the meeting that I just attended, they talked about 3 big topics. Of course, leases. And it was very interesting because now they're talking about post-implementation. Now, if you're sitting here and you haven't thought about implementing leases, you're way behind. If you've done 2022 GAAP basis financial statements and you didn't take into consideration the lease guidance that came out, talk with somebody real quick, because you should have implemented it, and your client or you should have adopted it for year ends, at least the year end 12/31/22. If you have fiscal year ends, you should be thinking about it right now. So they talked about leases, they talked about the impact. One of the attendees was talking about the impact on covenant, ratios, and how the banks, a lot of the banks haven't been thinking about it. Now I know I went and I did probably 6, 10 different presentations at different banks about the lease pronouncement all the way back from 2015 on. And still banks are sitting here saying, I didn't know that this was coming out. One of my clients, their assets went from around $75 million to $105 million because of the lease liability and right of use asset was put on the book. So it had a significant impact, and you have to just be wary of that and watch for that. So they talked about leases. They, of course, talked about CECL. And then there's a new equity type of award that they're referring, and I recommend that you look into or watch some of these presentations because they're really, really informative. Okay. On to ASU 2023-04, liabilities. Now, it's amendments to SEC paragraphs pursuant to SEC Staff Bulletin number 21. So I know a lot of people going, SEC. Keep in mind, whatever comes out, and Frank Boudelet and I say this all the time, whatever comes out from PCAOB tends to trickle down. Whatever comes from other areas tends to trickle down, and it does affect us at some point, and it's really great resources. I'm not recommending you go out and read the SEC Staff Bulletins, but you should be aware of what's going on. So what is an SEC staff accounting bulletin, or a SAB? A staff accounting bulletin summarizes the views of the SEC, the Securities and Exchange Commission staff, regarding how generally accepted accounting principles are to be applied. A common result of the requirements of a SAB is that they're more conservative and or restrictive than GAAP, for which they are derived. So when I used to do a lot of SEC work, we would have to look into these SABs to see We understand GAAP, we understand the application, but we need to know if there are any of these staff accounting bulletins out there that could affect the accounting that we're doing. So keep that in mind. Now, you're sitting here saying, doesn't affect me at all. Well, if you have a company that could potentially sell to an SEC company, it may affect you down at some point. So it's always something to be concerned about. Now, what did SAB 121 say? So rather than just talk about the ASU, we'll talk about the SAB itself because it's actually referenced within the ASU. It expresses the views of staff regarding accounting for obligations to safeguard crypto assets an entity holds for platform users, okay? The obligation associated with these arrangements involve unique risks and uncertainties not present in arrangements to safeguard assets that are non-crypto assets, specifically relating to technological risk, legal risk, and regulatory risks. So if you have a company, right now this is just SEC companies that is addressing this, that is dealing with crypto assets, you need to look into this because this just came out and the SAB has been out, but this conforms the accounting codification with the SEC guidance. In line, so it's not an enormous pronouncement, but you should look into it. In line, the FASB also voted to issue crypto asset standards. So while I said 2004 and 05 came out, they're going to be coming out with more standards too this year. FASB also voted to issue a crypto asset standard that will require entities to report fungible crypto holdings using the fair value measurement standard. Now, I know that you've heard me talk about this over past episodes, but now they're going to be putting it into effect and have an actual standard come out addressing this. Requiring an entity to, at a minimum, present the aggregate amount of crypto assets separately from other intangible assets that are measured using other bases, present gains and losses from crypto assets and net income separately from other income statement effects of other intangible assets, classify crypto assets received as non-cash consideration in ordinary course of business that are converted nearly immediately into cash as operating cash. Okay? Now, what that could affect too are nonprofit entities. So while I was talking about SEC before, this recent part that I'm talking about really relates to FASB and all companies in general, including nonprofit organizations. To be a crypto asset, it must have the following. Now, you may have seen one of my presentations where I talk about IssueWatch issuing the taxonomy on crypto assets. This kind of marries up to what they say. It must meet the definition of an intangible. It does not provide the holder with an enforceable right on goods or services or other assets of another organization. It's created or resides in a distributable ledger based on blockchain technology. If you don't understand that, look at Sean Stein-Smith's presentations. The guy is amazing on talking about on that topic. It's secured through cryptography. It's fungible. It has to be fungible. And it's not created or issued by the actual reporting entity itself. Okay? Those are the big things that came out from that. ASU 2023-05, we talked about this when it was coming out, and now it's finally out. Business combination, joint venture formations. So you're sitting here saying, well, I don't know if I have them. Well, let's find out. A joint venture is a formation of a new entity without any accounting acquirer and is an entity owned by and operated by a small group of businesses as a separate and specific business or project for the mutual benefit of the members of the group. It measures its identifiable net assets and goodwill at the formation date. So at the formation date, that's when you actually measure the value of everything. The initial measurement of the total net assets is equal to the fair value of 100% of the venture's equity. It's requiring enhanced disclosures, and it's effective for all joint venture formations on or after January 1st, 2025, with early adoption permitted with retrospective application to be applied. So you're sitting here saying, I don't know if I have these. Well, you should look at any business formations and see if it's applicable. I happen to have a client that was tax basis financial, but still I had a client that it was a real estate entity that one person put in the building and property and the other person put in cash, and they created this really tenants in common entity, and in essence it is a joint venture. Now, what was interesting was when we went to prepare the financial statements, we realized it's on a tax basis. Now remember, if you prepare tax basis financial statements, they're supposed to reflect what's on the tax return. And I had this discussion with somebody recently in my office. They said, well, I'm preparing the financial statements, but it doesn't match the Schedule L on the tax return. You see, Nicole, I actually know some of the forms. Doesn't match the Schedule L on the tax return. And I said, well, it has to, because it's supposed to mimic what's on the tax return. Now, it doesn't have to go line by line specifically, but it's supposed to reflect the information that's on the tax return. The problem is, this joint venture, I don't do the tax return for all the businesses. So how do I know if it reflects the tax return? So we had to do some special documentation and some other information and reporting to make sure that we could present this entity on a tax basis accounting. So these are little things that pop up that you should know about. And what I recommend that if you have questions about this or weird things come up like this, reach out to me. Or even better, what I've seen a lot of people doing is go into NJCPA Connect and put some of your questions up there, because there are a lot of really good members and they're really smart, and there's some that are just opinionated, but they're really smart and they are willing to help you. So I recommend you use that resource that's available to you. Okay, in closing, I want to share a few upcoming NJCPA accounting and auditing events. Focus on engagement quality. How to avoid deficiency in peer reviews is being held on September 22nd and can be attended in person in Roseland or virtually. And the Essex and Morris Sussex chapters are holding an A&A update on September 22nd in East Hanover. And the Union chapter is holding a session on compilation reviews on September 27th in Clark. Get the details for these events and more at njcpa.org/events. And lastly, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.